Wall Street will create any product you can imagine.
That's right.
And anytime you've got a payout, like whether it's monthly or quarterly payout, that is higher than what the market is paying, you need to ask yourself, where is that additional yield coming from? Is it coming from my principal? Sometimes we see that with real estate investment trusts. They've got a payout, but actually their principal value is declining. So we see that. Is it coming from principal? Is it becoming because there's some options that are being sold to generate that? And if that's the case, well, what's the trigger point where my assets are now going to get called away from me?
That's 100%.
And then what's my downside here?
So Scott,
there are times when these things might be appropriate as a piece of one portfolio managed within.
And typically over the short term. You have to have a reason behind it for the short term, because otherwise it puts a drag on the portfolio, which normal market cycles you can live through and not pay that insurance premium to sell these.
That's exactly right.
Right. So I pulled this article, just happened to pull this article from Jeff Sommer from the New York Times, and he talked about investing, but he said one of the ways it isn't easy to invest. First, much of the financial service industry is dedicated to incessantly selling new products and services, including advice intended to keep you buying and selling the latest new thing. That kind of behavior generates profits for asset managers and advice givers, but not necessarily for you.
That's why he just read that this week.
I read it last night.
Oh,
and I said,
what does that? Read that one more time.
It said
thinking about something different.
Why it's difficult to invest, by Jeff Sommer, New York Times. First, much of the financial service industry is dedicated to incessantly selling new products and services, including advice, intended to keep you buying and selling the latest new thing. That kind of behavior generates handsome profits for asset managers and advice givers, but not necessarily for you.
So one of the reasons you hear us talk about the importance of working with an independent advisor, look, the big Wall Street firms, I'm not going to pick out the names, you know the names, they manufacture this stuff.
They manufacture products.
So I'm going to pick a company. What's the difference? Because it's true. Like Merrill Lynch. Okay? Merrill Lynch has many lines of business.
Yeah.
One of the business lines is offering advice to clients, and they'll do some on a fee basis where they'll try to make sure the interest of the advisors are lined up with the clients. And so when the clients do better, they'll do better. That's part of the structure. But they also manufacture some products, things like this. May not these particular ones, but they have other financial instruments that they manufacture. Further, they are in the business of helping other companies raise capital by selling their bonds or their stocks. So they're going to some company and say, hey, we can raise $4 billion of bonds for you. Where do you think those bonds go?
To those Merrill Lynch, right?
I mean, that's partly, yeah.
They also are in the business of selling home loans and banking advice. And they're scored on it.
That's right.
So what's the point of
Your
actually
financial
having
advisor,
an advisor take money from your portfolio and pay off the home loan if they can get you to borrow the money from them?
Their pay grid, as they call it, to your point, Pat, they're scoring. I remember talking to one guy who says they have to have a certain amount of credit cards. They have to have people sign up every year. More loans, whether it's against the portfolio, security-backed lending, or it's a mortgage.
Really? I've heard about it, but I've never talked to anyone that you talked to a guy that had it.
Yeah.
Did he hate it?
You know the guy I talked to. Yes.
Oh, I've never talked to him about this. But imagine selling credit cards to clients. Holy smokes.
Pat, they got all kinds of benefits. You kidding me? Look at this. You can get a go on the cruise. Okay. You get free upgrades on the cruise.
Anyway, but Scott, in all fairness, it's independent advisors. There's good ones and there's bad ones
for sure. And at Merrill Lynch, there's great advisors that say, "Hey, I don't care about your management. I'm serving my client. My client comes first. I'm going to ignore you and all that other garbage." For sure.
Yes.
For sure. And you can have an independent advisor who's a
dirtbag.
Yeah, correct. Or inept or both.